nasty.
The rates are a little lower on a 15-year fix, especially if you have a lower credit score. Because of that, a 15-year loan actually doesn't hit you for credit score on Fannie and Freddie, where a 30-year, they adjust you for credit score. The number one thing I tell people, anybody who's just not bought a house before, don't get into more debt before you buy a house. You want to buy that Tesla, you want to get that car or whatever, get it after you get in your house, because that will affect how much house you can get. Bad news makes rates go down.
Okay.
Good news makes rates go up.
Okay. So obviously everyone knows it's a pandemic, but the good news about the pandemic, one of the only good things about the pandemic, is we are at historic interest rates at an all-time low. They're pretty much close to zero, and it's never been this low in the history of the United States. And for that reason, if you're looking to get a loan or you're looking into potentially buying a place, this could be the time to do it. So today we have one of my best friends. His name is Ryan Eldridge. I call him the captain, but he is the man. And this year he did something over $110 million in loans. And he is an amazing individual who has helped people get into the homes of their dreams, and he does it on a daily basis. Captain is a hustler, and he teaches us in this podcast that, his number one skill is that he has anti-procrastination. He gets shit done immediately, and he gets it done as soon as possible, and that's what's made him so successful in his industry. If you're looking to potentially buy a house, get a loan, refinance, this is the podcast for you, and this is probably the time to do it. So listen on in. You're going to hear some great information and realize that it's super easy to get a loan and to potentially get into a house, which could be the step into your future. Chime on in. So, hello everyone, and welcome to another episode of the Nasty Truth Podcast. For the next couple episodes, we're going to be talking about one of my favorite topics, and something that's really hot right now is going to be real estate. So, I have with me today my good friend Ryan Eldridge. Captain, thank you for being here today.
No problem.
So, let me tell you a little bit about my friend Captain here. So, Captain is somebody who's been in the mortgage industry for about 20 years now. He started off as an underwriter. He's gone through many positions within the mortgage world. He has worked at many different companies, and essentially through the years, he has now become one of the top loan officers in all of Southern California for a company called American Financial Network, correct?
That's right.
And he is now in the top 10 of all loan officers within all of American Financial Network, and that's out of 900 loan officers, okay? That's something that's extremely impressive and extremely hard to do. Now, right now in this market, we have Captain who's here. He's been crushing it lately. Just to let you know a little bit more about Captain. Captain has about 14 children. He's our go-to guy when it comes to figuring out how to impregnate your girlfriend or your wife, because he's so good at it. I know, I'm just kidding. He has 5 lovely children, but he is just the man's man, and he's a great father. He loves spending time with his kids, and he's also big into outdoors, snowboarding, traveling, and he prefers to live in rural areas, even though I've been trying to drag him down to Orange County. He likes the desert or the mountains, just anywhere where there's no human beings, it seems.
Less human beings.
Less human beings, yeah. Exactly. I don't blame you. Sometimes human beings are the worst kind of human beings.
It's a lot of energy to deal with.
So, Ryan, I'm super excited to have you here today. Ryan, why don't you tell us a little bit about yourself if I missed anything, and if not, we're going to get into talking about loans, mortgages, and the real estate market right now.
Yeah, you pretty much summed it up pretty good. Again, my name is Ryan Eldridge. Work for American Financial Network, Southern California, Orange County based actually, nationwide lender, currently funding close to $1.5 billion a month, which is pretty good out there in the mortgage world. Not the biggest, definitely not the smallest. And I love the company, have been there for 8, almost 9 years now. As a branch manager, and it just keeps getting better and better. If anybody wants to apply with us, you can just apply at refywithafn.com. It'll take you straight to our app, and yeah.
Awesome. Well, I know also you work completely virtually. Is that true?
Yeah, I built a quasi-commercial office on my property that's separate from the house because of the 14 children that you mentioned, of course.
Yeah.
But yeah, mostly virtually. Have rented office spaces before and had some small spaces, but my entire team is essentially virtual, other than coming to me for training occasionally and things like that.
Yeah, I remember us talking about, you said that you have a couple people working in Sacramento, some in Washington. I mean, it's really just a testament to the climate right now, right? It's like, I mean, before this even, you were virtual before this happened, correct?
Yeah, I've been virtual for probably most of my career. There was a time when I had a partner and we were, growing and had a big office and weren't even doing as much volume as we are now, but we had a, 4,000 square foot office in Irvine and maybe, 15 or 20 employees counting loan officers. But it's pretty expensive. I mean, it's $5,000 a month, for an office, probably more now, in Orange County. And doesn't really make sense when most people, you can tell if they're productive at home or not. You can see what they're doing.
So the loan officers that are working for you now, are they work on as like full-time salary base, or are they on like per loan, like processing base?
Loan officers are 100% commission. So they're paid on what we call basis points or a percentage of the loan amount. And they work 100% on commission, no base pay, no hourly. Per the laws in the industry, if someone's required, if you work for a big company, we call them sweatshop loan companies, probably can't mention their name. But anyway, so if you work for a bigger,
maybe you should.
Big sweatshop mortgage company, they say you have to be here for like 12 hours a day, and they pay them awfully small commissions too. Yeah. And they have to pay the minimum wage, but they do it as a draw against the commission. But if you're telling someone you have to be here, you got to be online, logged in for this many hours, you have to pay them hourly. I tell my LOs, you make your own schedule, work wherever you want. Of course, you're going to make more money if you work all day during business hours and all night, if you're in different time zones, and people are calling you. But yeah, long story short, they're all commissioned, the ones that work for me, and I don't micromanage their hours. I just expect them to be rock stars.
No, hey, I completely understand. Two of my employees, they're, what I would consider full-time, but they work based on the hours that they want to put in. As long as they get their shit done, I don't really care. And, I pay them according to the work that's done every single week. It also gives them the flexibility to take on other projects and to hold other jobs that they might be interested in also. So I think this is the kind of like the way the world's going towards right now. Yeah. And I think basically COVID just like sped up the process, right? Like everybody was going towards working virtually at home because all you need now is a computer and you can do anything anywhere. Yeah. I mean, except for when I have to go to the courtroom, I can do anything from my computer that I can do just, even now we have video conferences when we check in with the judges through court call and we don't even have to be there in person. Yeah,
we're really testing the limits of what can be done virtually right now. And I've always thought that it was kind of ridiculous to have so much commercial space everywhere in the past. I mean, ever since they had go to my PC or what do they call it? The, remote access into computers, I just have not understood why so many people had to go into office. And I suppose there is a certain synergy, that happens in an office and people getting together and, all that. But again, Zoom and, you guys can meet up once in a while if you want.
Yeah. I mean, there's definitely something to say face to face, but I think that you can get just as much done over virtual if it's necessary. I can agree with that entirely.
If you have good people too. I mean, there's certain types of employees that have to be micromanaged. I don't want any of those employees working for me. I pick people that are, even my hourly employees, they work from home. They have to be honest. They've got the processors, they are all paid hourly. They get tons of overtime right now because it's so busy, but I have to just trust that they're at home. Clicking that clock, not when they're having dinner with their family or out on a hike or whatever. And they're honest and you can see it. I mean, if someone's not highly productive and there's tons of overtime going on, there's going to be, some talks that need to be had with them on a manager level.
Understood. Yeah. I remember reading a statistic recently that was all about how in the next coming years, that Entrepreneur magazine, I believe it was, they released something showing that over 28% of people, even when the pandemic is over, is not going to go back to work in an office. That actually the companies are incentivizing them to stay home, to work from home because it's cheaper for their overhead. Yeah. They found that people are more productive actually because they're not spending 2 hours of their day having to drive places, go to lunch. They just get stuff done. And so it's going to change our entire world drastically. I mean, this is something I'm paying attention to, of course, because I'm a PI attorney. I like people to drive to work, right? I depend on people to go outside and live their lives. And now that that's not happening, I'm going to have to adapt appropriately, right? That means a third less people on the road every single day is a big deal for an industry like mine.
Yeah. It's crazy. There's probably going to be a lot less car accidents with even less cars on the road.
So what I want to talk about right now is, the industry right now, the real estate market itself is something that's very crazy. It's something that's never happened really before because we're looking at interest rates that are lower than ever before, right? And I've heard that interest rates right now are getting locked in for a couple years. I really want to talk about first the current status of the market in this COVID climate and what your thoughts are on it and why we're seeing such a refi boom. Because you told me 90% of your loans right now are refinances.
That's correct.
Why is that? What's the current status of the market? And let's kind of break it down for people so they can can understand really what's going on, because I think everybody hears these terms, they talk to friends like, oh, refinance. Well, why should they do it now, and what's going on with the world?
Well, right now rates are, I think, lower than they ever have been in the history of since there was mortgages in America, at least. I'm not sure what's going on in Europe. I've heard they have 1% rates there. Yeah. Which I think was also done to stimulate the economies there. That's kind of what's happened here. You hear about these bailouts, or not the bailouts, rather the stimulus packages, and the government has basically purposely dropped interest rates, overnight funds rates, and started purchasing more bonds in order to drive interest rates down, which trickles through into the mortgage business and the rates that people actually pay every day on their loans. And they've done this in response to COVID, because everyone thought that the whole entire world was going to fall apart when all the businesses had to shut down. Maybe true. Maybe this is a good thing. Maybe it's going to get us through it and we won't have some big recession. So because of that, we are seeing the absolute lowest rates ever, down in the mid twos for most 30-year fixed mortgages right now with, good qualifications. And they've never been that low. We thought they were never going to get below the threes before. We had another refi boom back in 2012. So every person in America with a mortgage, with a job, who can qualify, or income, they all want to get a mortgage right now. I mean, they may not all want to, but they all qualify for some sort of benefit. So I heard some statistics that there's something, I don't know, it's somewhere in the trillions, multiple trillions of dollars in potential, eligible refis right now. And the mortgage industry can only handle a fraction of that, even in an entire year, based on all the lenders that are currently approved. So
why can they only hold a fraction of that?
Because we only have so much capacity. We only have so many employees. It's a lot of work. You've seen it.
So yeah, I understand. Yeah, so you're saying it's not so much that there isn't enough money available. It's more just because right now everyone's inundated with so much work that they're having trouble keeping up.
Exactly. And lots of lenders are going, taking 2, 3, 4 months. We're getting backed up to over a month now, which I don't like seeing, but I mean, it's everybody. Everybody's inundated with business right now. It's a good and a bad thing at the same time.
Yeah.
Everybody's making great money. Everybody's turning out big numbers. But it's also, causing worse service to the customers because it's taking longer. They're having to provide more documents and update things.
But let me ask you a question about that, because I remember back in 2008, because I did work in the mortgage industry around that time for a little while. We could do stated income, stated loans. It's not the same thing that it was years ago. People are having to still go through the proper processes, and they really fixed a lot of the stuff they messed up 10 years ago, right?
Totally. Yeah, totally. And one thing that I want to say that is a big misconception, I think, among most people, is most people think that we can have another housing crash like that. Everyone's waiting. Waiting. Oh my God, I'm going to wait till they drop 50, 75% in some cities like Las Vegas, like it did before, and then I'm going to buy my house. That is impossible for that to happen now. I'm telling you, I worked in the industry starting in 2003. I worked through the whole 2008 thing, and around the 2008 thing, that's when I started learning about Fannie, Freddie, government programs, the stuff that the whole mortgage industry is today. All the programs that are the full documentation products, the products where we really do analyze and make sure people can make their payments. And everyone is in fixed loans and fixed payments now. And it's cheaper than rent most of the time. Rents have gone up. People are not going to lose their houses. Even if they lose their jobs, they're going to get roommates. They're going to figure it out, because what happened last time is all these adjustable mortgages, payments went through the roof. Nobody was qualified to know, no underwriter knew if that person could really make it. They all said they made 10, 20 grand a month at McDonald's, and they just gave everyone a loan.
So we're going to get into a little bit later on down the road. I know that you've mentioned a couple of terms like Freddie Mac, Fannie Mae type loans. You've also mentioned adjustable arm loans. These are all terms that a lot of people probably hear, and not only do they hear, but they got tricked into getting 10 years ago, and they still don't understand what they really mean. We're going to get into that a little bit further on down the road. I just want to make sure that we discuss the current climate so everybody kind of understands where we're at, but we're going to discuss the different types of loans and why these things cause the crash and why we don't think it's going to happen now. Okay, so you're saying right now, because of the types of loans that we're getting into, which are government regulated, we're making sure that all the I's are dotted, all the T's are crossed, and really it's just a different structure than it was a couple years ago. And I've also heard this too for some very high level financial advisors, that there's just no crash and there's no sight of crash coming down this way. And I've also heard too that the interest rates are being locked in for a couple years. Can we talk about why the interest rates are being locked in and what's going on there?
Well, that's just news from the Fed. We don't know if it's actually going to happen. Sometimes the Fed says things and things don't happen. Even when this first COVID crisis hit, we saw some really good rates. I refinanced you the last time, and that's when I started getting really busy this year, you know, from basically taking a vacation in the first part of the year. And
so you're saying world news has a huge effect on the interest on your industry.
Yeah, huge. I mean, just, you know, right now rates are going up, and we don't know if it's going to be continue or just it's a short thing, but because of this right now, as we speak, there's possibly another stimulus deal being struck up in Washington. And so that makes people think, oh, the economy is going to be great. They're stimulating it again. So we can raise rates a little bit. Bad news makes rates go down. Good news makes rates go up. When they were talking about a COVID vaccine, which I don't think ever panned out, rates shot through the roof for a few days. You know what I mean? So
shot through the roof mean they went up.
Yeah, they got worse. They got worse, and they're very sensitive to news and things the Fed says and governments are saying, and stock markets.
Got it. So it's almost like the government's trying to balance out when they think that everyone's going to go into panic mode and freak out. They want to keep the economy going steadily. So if something really good happens, they think that, okay, people will keep paying. They're all happy. They're not in a bad mood. So we'll raise the rates a little bit. But when shit happens and people freak out, they're like, we need to allow people to keep their money so that they're not freaking out and maybe lower these rates a little more. Yeah,
raising rates is the only way that they have to control inflation. Keeping rates too low for too long will make prices go through the roof. If every house costs 0.5% interest rate to get, it's going to drive prices up because the monthly cost, which we all look at monthly cost in all of our budgets, is going to go down. And that's the reason why a 2.5 rate right now is cheaper than rent. And that's the reason why no one's going to let their house go into foreclosure. They've got equity. They've got a cheaper than rent payment. They're going to figure it out. They're going to figure. We may see the market stagnate if there's inflation, if there's a stock market crash. There could be some other type of recession, but I do not think personally, my personal opinion is that, I mean, that was an anomaly. We should have all bought as many houses as we could in 2010.
When the crash happened,
you know, I don't think it's going to happen again. They may just stay the same. They might go down 10% or something like that, but nothing that everybody's hoping for. They're going to be waiting forever.
Okay, so now that we've kind of talked about what the current status of the market is, and you know, you're not the only person I've heard this from. A lot of people are saying there's not going to be a crash, and so people need to plan accordingly, or, you know, refi now because this is a great time to take advantage of these things. So let's get into first home buyers when they're coming in to buy their homes, okay? And then we'll get into what a refinance is later, okay? So when somebody's coming to get their first home, what are the things that they need to start thinking about? You know, what are the things that they should start considering? Like when somebody calls you and says, hey, I'm looking to buy my first house, you know, we want to figure out what we can afford. What are the things that you recommend for people to start planning in their minds before they start jumping into this decision?
The number one thing I tell people, young people especially, or anybody who's just not bought a house before, don't get into more debt before you buy a house. You want to buy that Tesla, you want to get that car or whatever, get it after you get in your house, because that will affect how much house you can get.
Okay, why is that?
Because your debt to income ratio is what we use to qualify you, and that counts all of your debts. If you've got a $700 car payment, that's $700 less mortgage payment, which could be an equivalent of $100,000.
So let's talk
and more
about
loan.
Debt to income ratio means how much debt you have to pay every single month versus how much money you make every single month.
Correct.
Do those numbers or those percentages have an effect on how much money we can get lent to us?
Of course, yeah. So, I mean, the general rule of thumb is you have to have less than 50% debt against your gross income. If you're self-employed, your gross income would be your net that reports at the bottom of your business return or your Schedule C. If you're someone who works for another company, your gross is going to be your gross before taxes, what you make. If your base pay, if you have bonuses, if you have commissions, that's all got to be averaged on a 2-year average and be consistent for 2 years, or we cannot use it.
Got it. So you're saying 50% debt to income ratio is really where you should be at,
or less. Yeah. So depending on your credit, depending on what program you're doing, some may require 45%. But generally, speaking, 50% is the absolute max. You can't go over that. So if you make $10,000 a month, you can't have more than $5,000 a month in debt, and that includes your new house you're trying to buy with the HOA and the taxes and the insurance and everything.
Okay, so now that we have figured out what our debt to income ratio is, right, and you said that there were some differences. So, right, for example, I can use myself and my girlfriend as examples, right? I'm self-employed. On paper, right, I make a certain amount of money, but a lot of it goes to expenses in my company. So my income actually doesn't show as high as somebody who just makes a regular salary. My girlfriend makes a regular salary as a nurse. She makes the same salary every year. Maybe it goes up 10%, maybe it goes up 5%, but it's pretty consistent, right? So something like that is almost more valuable than a self-employed person unless I can show multiple years of consistent income at a certain level. Is that right?
Yeah, and sometimes, again, depending on the loan program, you may only have to show 1 year of income. So you could have had a really good year this year, and that may be beneficial to you. Once you get into making really big bucks self-employed, you're going to be fine,
Yeah.
But yes, when you're just starting out a business or a company and you have lots of write-offs and lots of new equipment and things like that you're buying, depending on how you do your taxes, and there's strategies with that me and, my loan officers can advise on with people as well. Yes, to answer your question, yes, someone with a solid salary could look much better. And honestly, it's an easier loan for us. Self-employed requires a lot more documentation, especially with COVID. They're worried about businesses shutting down left and right. We see it happening. They're closed out there. So.
Yeah, I remember reading a statistic that 80%, I think it's 80 to 85% of small businesses shut down within the first 5 years. And then something about like in the first 10 years, out of those 20% that survived, only like 60% of those survived, or like 40%. I think it's a smaller number survive out of those. So it's some crazy statistics. I know everybody right now is freaking out because they're seeing all these small businesses are shutting down, but it's actually quite normal that many small businesses shut down every single year. Yes, COVID is having an effect, but I don't think it's as drastic as what everyone thinks it is. I think it's pretty normal for many small businesses to shut down on a regular basis.
It is, yeah, and the COVID thing is an accelerant to that, of course, with not being able to have your doors open for, however many months, depending on the laws wherever you live. And that doesn't help, because some of these people, these businesses are paycheck to paycheck. They don't have a lot. You should have a lot of reserves. All you guys out there trying to start businesses, keep 12 months reserves if you can. I mean, that's the smart thing to do, and your business will be able to weather those kind of storms. Yeah,
it's definitely tough. I mean, it's definitely, something in my industry is we're signing up, 15% as many cases as we used to be signing up on a regular basis because people are not out driving their cars, right? So like I luckily have been smart enough to pivot, and I'm doing a lot of employment law type stuff, but most people are not smart. They don't think that way. They're just like, it'll be over soon. It's going to be fine. And they don't have any reserves. So when something like this happens, they literally have to shut their doors and go work at McDonald's or something until they can figure out their next step.
You have to shift with the market. No matter what industry you're in, you have to go with the market. You've got to be willing to change. You've got, all those guys back in 2008, a lot of them are bartenders now because they weren't willing to get full documentation from their borrowers. They were so used to doing easy loans where you didn't have to show paycheck stubs that they didn't want to learn. Those who shifted and those who learned, they're making great money now in this refi boom. And the mortgage industry is very lucrative still. It's a lot more work than it used to be. There's a lot more regulations, a lot more underwriting, but
that's good for the consumer.
Just as lucrative as it was back then.
Yeah, and it's almost too, I feel like as a loan officer now, you feel proud to be a loan officer because you probably got this bad shtick from 2008. Everybody fucking hated loan officers.
Now we're helping everybody.
Like, you guys are criminals. You guys are pieces of shit. You guys made the entire industry and the economy shut down. I'm sure that everybody hated loan officers.
Worse stigma. I mean, I remember going snowboarding, and I always was successful even through that because I worked very hard. I'm more successful now than I've ever been just because of my experience. But even back then, I worked very hard. I may have still been learning things, but I worked hard. I always made it. I always did good. I always owned a home. I remember snowboarding, in maybe 2009, I don't know when it was. And, some guy would ask me on the lift, like, what do you do? Oh, I'm a loan officer or whatever. I'm in the mortgage business. And, oh, sorry about that. It's like, actually, it's pretty good. I'm making money right now while I'm snowboarding, taking a call. But so there was a very bad stigma. And now everyone thinks we're great, because now we're just lowering people's payments and, nobody's really getting screwed out there. It's too competitive. I mean, there are people that will screw you and try to gouge you.
But at the same time, I understand how people get mad at the loan officers, but they should be mad at themselves too. Don't get into a loan that you can't afford just because you want 30 grand cash now and then be mad that you lost your house. You shouldn't be stating your income is 150 grand if your income is 50 grand a year just so you could afford that boat for a couple of months, then it's going to get foreclosed upon. I mean, there was a lot of, not to point fingers at people, but people need to take accountability. We've created, I think, such like a victim mentality and victim world that we live in nowadays that people just don't take accountability for the mistakes that they made. They want to point the finger at somebody else when it wasn't your fault. They called you asking for a service and you provided what they asked for. You should be the responsible adult and not sign up for an $800,000 loan that you can't afford. Like, that's the real problem here.
They made it way too easily available, and unfortunately, if you make it available, stupid people are going to take it. You know what I mean?
I agree.
So, that's the problem, and that's why the government had to step in and pull in the reins and say, no, we're just going to not make that available anymore. And it's not even the government, it's also the investors, all these, whoever's throwing up that money. It was a bunch of private investors and from all over the world. They were putting up that money for those type of loans. It wasn't Fannie Mae and Freddie Mac and FHA. It was rich people all over the world, and these loans were performing great because property values kept going up because appraisers were lying, and of course they're going up because everybody can get a loan. There's so much competition. They're driving prices up. The guy who works at McDonald's can get $1 million house.
It's crazy.
So again, yes, I think it's changed the mentality of people a lot because a lot of those people lost their ass back then. And a lot of them now, they're being a little more frugal. I know I certainly am. I didn't quite lose my ass, but I was racking up lots of credit. It was just the mentality back then. And now it's like cooler to save money. Now I live in, a cheap area and I make better money than I have in my life. So, it's definitely a shift of the mindset.
One of my best friends always says, it's not about how much you make, it's about how much you take, right? That's really what it comes down to. Okay. So we talked about debt to income ratio. Okay. Now let's talk about what other things are important. So I know income is important. Your credit score is important. How much do you know about credit scores? You obviously have ran thousands of them throughout your career. How does credit score, I think people hear credit score. How does that get calculated? What does it mean? And why does it have such a big effect on your mortgage or your loan that you receive?
Well, these days, you pretty much have to have at least a 620 credit score to get any mortgage. It used to be lower before COVID. They've restricted a lot of things. Now, a 620 is kind of below average. I mean, you can have some lates on some stuff, you can have some debt, you can have some collections, and probably still have it. Once you're below that, and they did, even FHA did lots of loans below that, and they may come back soon, there's usually a lot of credit problems. I mean, you just have to really not give a shit and just, you get a credit card, forget about it, or just pretend like it's not there and goes to charge off or collection. The way to get your credit score the highest possible is to have a few accounts, maybe just 2, and keep them paid down as much as possible. Keep them low, use them, but keep them low. And it's smart for yourself too. You don't want to be wasting money on interest. Couple accounts, keep them low, pay them on time, don't get collections, don't forget about shit, forward your mail. You know what I mean? That's the key to having a higher credit score. It's very important to have a high credit score because you're going to get a way better interest rate, especially on a conforming Fannie Freddie loan. So I mean, now that you bring this up, for example, my girlfriend, she has a almost perfect credit score, which is amazing. She has 800, so she's crushing it. But for me, I do pay my bills every single month, but now that you bring it up, I have a lot of expenses for my company, right? We're spending tens of thousands of dollars a month pretty consistently just on their credit card, so it probably has an effect on me. I need to pay it sooner or do something like that to raise the rates as much as I can, or to raise my score as much as possible. Well, we can time that out too. We have software built into our credit vendor that we purchase credit reports from, and it tells us, Joe has potential for plus 40 on TransUnion. Oh, wow. Yeah, so I can say, Joe, pay down your Amex, the card you're swiping for your business all day. Go ahead and make a quick payment for $5,000 because you're going to do it in a month anyway. And you're going to have a 740, and then I'm going to get you a 0.25% better interest rate. That's amazing. So is this software proprietary towards your company, or is this something all loan officers use? I think most loan officers have access to it. Some of them may not be savvy on it, but it's something, and some people try to charge for it, other companies, which is stupid. But is it a free tool online, or is it something your company pays for? It's not online. It's a professional account with a credit company, so we have to be a professional company allowed to pull credit reports, and it's built into the software. We pay, you pay $95 for your credit report when your loan closes. So it's part of that cost of the credit report, and we do it for free. I've worked with people for years getting their credit built before they get their first house, just to get it. And I do that just to get the future business, and they love me forever. And they refer people because you help them for free. I mean, let's talk to the viewers here for a second. So if your loan officer is not somebody that does something like this, first of all, you need to find a different loan officer, because the bottom line is he's telling you that he is strategically planning to help get you a lower interest rate and a lower mortgage payment every single month. This is something you're going to be locked into for 15 to 30 years, sometimes 10, but most of the time it's going to be a 30-year loan. And if you don't have somebody like that who's on your side, you need to double think things. But it's also smart for you to strategically think about how you can optimize the best way possible. Because I know it doesn't sound like a lot, but if you get 0.1, 0.2, 0.3 lower on your interest rates, this is hundreds or thousands of dollars on a mortgage that you could save every single month. And over the life of the loan, this is tens of thousands of dollars. Hundreds sometimes. Yeah, hundreds of thousands of dollars. On super expensive properties, you're looking at paying double the amount of the loan. So if you have 0.2, 0.3, what are the numbers when you're paying a 30-year loan? How much does it end up being over the life of it? 200% or something like that? I'd have to pull up a amortization schedule. Well, right now rates are pretty low. I'd say maybe maybe like total interest, if you get a really good rate, maybe throughout the life of the loan, you might pay 150% of the cost of that loan, even with a 2% something rate, you know, just because it compounds over time. 2.5 times 30 years, that's, you know, that's 60, what is it, 60 or 2.5 times 30 years? Yeah, it's like 70% of the loan right there. But of course, as you pay it down, the interest gets less and less because it's on a less amount as you pay that balance down.
But the basic gist of it is that you're going to be saving tens of thousands of dollars for these people just by planning accordingly and making sure that you're getting them the best rate possible. So make sure when you're making a choice like this is, you know, they call it mortgage. It's supposed to be your death. It's gauged over the entire life of, you know, your life. So you want to make sure that you're getting it with the right person, that you're getting the right rates, and that you have somebody helping you plan accordingly for this. Yeah.
Correct. Yeah. You want to make sure someone's on your team. They're treating you like a family member. And that's one of the things I pride myself on, and I tell all my loan officers to do as well. Yeah. Just pretend you're talking to your cousin or your brother. I mean, really feel it. I mean, feel for them. Yeah. You know what I mean? Advise them how you would advise yourself on that loan. Care that much. Don't worry about the long game and the extra work on a lot of people don't want to do that extra work on the credit reports and things like that. They just want those quick deals, close the deals. But you know what? That long game gets you consistent business when you're not marketing and when the business is not in a refi boom.
I mean, you know, the bottom line is referral business is something I preach all the time. It's significantly better than ever when you're just getting marketing offline. When people call me off marketing for my firm, I love it. But at the same time, I know they're usually calling 7 other law firms, and they're really just trying to vet people and look for the biggest discount. And they're seeing who will work for the cheapest amount so that they can save a little bit of money here and there, instead of somebody that just trusts that you're going to do what's best for them and is a word of mouth referral. So I'm all about it. Okay, so we've talked about debt to income ratio. We've talked about your credit score. What is also something else that people need to look at when they're coming to get a first-time home purchase?
Those two are really important. First-time home buyers as well, you need to figure out what your down payment situation is.
So let's talk about down payments. Okay, so down payments is something that people freak out about. This is why most people don't buy a home. They're like, I don't have enough money to buy a home. So the bottom line is they're like, I need to put 20% down is what most people think is true, right? But I know that there's other options for people to do. It can be like 20%, 5%, different amounts. So I want you to tell us what we need to know for down payments and what are the different percentages based on the different types of loans that we can do.
Well, you know, like you said, most people do assume 20% down, and that keeps a lot of people out of ever even trying or even making a phone call to someone like me and saying, hey, I want to buy a house. How do we do this?
Yeah.
It's not 20% down. It's actually 0% down is the minimum.
Oh, because I did not know that.
Well, there's 2 ways you could do that. One, you could be a veteran in a VA loan, and you can get any loan amount, even above the conforming loan limits, up to millions of dollars if you have the income for it, with $0 down. You can make the seller pay your closing costs, and you can move into a house with nothing out of your pocket if you're a veteran, if you've served in the military and you have VA benefits. Wow. So if you're a veteran, take advantage of that. I want to go enlist just so that I can, you know, because they're the best loans. They don't have mortgage insurance on them, which is something you hear a lot about and people trying to avoid. That's why the 20% down.
Yeah, we're definitely going to talk about it's called premium mortgage insurance, correct?
Private mortgage insurance.
Private mortgage insurance. Yeah. I apologize. We're going to talk about that later and what that means, but continue.
Yeah. So anyway, veterans, buy a house. You know what I mean? Like wherever you are, wherever you can afford it, buy a house, because that is hands down the lowest interest rate, the best terms, and some of the easiest loans to get, the most lax guidelines on VA loans. They want to help our veterans. So I specialize in VA loans. I've done them forever. I love them. They have streamlined refis where you don't have to even get an appraisal or show income, and you just lower your rate. They're awesome. So anyway, veterans, if you don't own a house, call us. Get a house, get yourself in a house, take advantage of those benefits, because it's all win for you. You don't have to put anything into it, and your house is going to go up in value. You're going to pay it down, and the rates are phenomenal. They're better than all rates.
Got it.
Other ways for 0% down payment assistance. Not my favorite thing to deal with, because it's like dealing with a second lender. Usually down payment assistance comes from local governments. City of Newport Beach might have a down payment assistance program for someone who's in a certain income range. There's definitely more tight qualifications for them, but we have several hundred down payment assistance programs we work with at American Financial Network, and they're all in different localities. Some are, every state, we were in all 50 states. Every states have programs. There are some federal programs. One of the most popular is called the Chenoa Fund. That one will provide up to 3.5% down payment for a borrower who's at or below the, I think it's the median income for the area.
Is that a higher interest rate than the normal mortgage rate?
No, these down payment assistance, sometimes they have no interest. They're nonprofits that are providing these. So sometimes there's no interest at all. Sometimes it's very low, 2%, or sometimes they forgive it if you keep the house for 3 years. Like the Genoa Fund, I believe if you keep it they put a lien on your title, like a second mortgage, and after 36 months, I believe they forgive that amount.
That's amazing.
Again, a lot more work for us, but we're willing to do it to help people. We think everybody deserves a fair shot at a mortgage. And again, you bend over backwards for someone, you get them an awesome product like that, they're going to tell their rich dad who wants to buy the $2 million house too.
That's perfect.
You know, or maybe if they had a rich dad, they wouldn't need down payment assistance.
Yeah,
but
that's also
but
true.
anyway, their rich friend, whatever. But anyway, so you know, we do these things for free. This is extra work we have to do. We don't get compensated on the down payment assistance. Extra work, but we do it because we want everyone to have a fair shot at a loan, and we would want that fair shot at that loan too if we didn't have a down payment and we were trying to get into our first house. So there's the 0% options. Going the easier route, in my opinion, conventional and FHA loans, 3% is the minimum down for Fannie Mae and Freddie Mac. Okay. The mortgage insurance is very high on 3%. So I recommend 5% if you go on those, which is what I had Joe do here when he did his. There's also FHA loans. If you have a lower credit score, you want to go FHA because the rate is not as affected by a lower credit score. If you're down at that 620 mark, I've got several clients right now, 620 scores, are doing 3.5% down. We're buying houses, and they're getting rates in the 2s.
That's amazing.
Yeah. Conventional, your rate would be much higher because they hit you a lot more for credit score on the conforming programs. But if your credit score is high, it's going to be smartest to go with a 5% down.
Let's talk about it since we're here right now. What is the difference between FHA and conventional loan?
FHA is completely government funded. It's a Federal Housing Administration loan program.
Okay.
The guidelines are more lax. You can actually go up to 57% debt ratio currently, not on your house ratio, but on your other debt. So they have a 47% housing. Hence, if you make 10 grand a month, your total housing payment can't be over $4,700.
Got it.
Your total debt with your $1,000 Tesla payment, it can't exceed $5,700. Okay. So that's, an idea of how debt ratio works in a simple way. FHA conventional, you will never get anything approved over 50. A lot of times it's 45 if you're only putting 3%, 5% down, depending on your credit.
Why do you think the government is more lax than private banks?
FHA was created to help lower income people get into houses, so they have more of a relaxed program. They also have expensive mortgage insurance because of their higher risk tolerance. So FHA charges you 1.75% and they tack it onto your loan up front. And then they charge you a monthly amount, which equates to 0.85% per year. Conventional may have monthly mortgage insurance, and it's probably not that much, but they don't have that huge. It's basically like paying points to get an FHA loan. It goes to them, not to us. It goes into a fund to cover losses because they do have a lot of them because they do risky loans. They even go down to 500 credit scores before the COVID crisis.
The FHA did this? Oh, wow.
Yeah. And I mean, we try not to mess with them. They're really hard to do. And a lot of things can disqualify people, but they technically will go down to a 500 score if you've got the right credit. They might make you settle on all your collections and things like that, and they might have to put 10% down instead of 3.5%. But
this was something created after the crash, or is this something that's been around a long time?
It's been around a long time. Yeah, it's been around a long time. I don't know what the market was before the 2008 crisis for FHA and Fannie and Freddie. To be honest, I worked in the business for 5 years. I didn't even know what the hell Fannie Mae was. I didn't even know, and now I'm an expert on it, and it's all I do pretty much.
Yeah. So we talked about FHA, we talked about conventional. What is a Fannie Mae? So
conventional encompasses all loans, non-government and non-subprime. Okay. So that means Fannie Mae, Freddie Mac, which we call conforming, which is a term commonly misconstrued for conventional because they sound similar, right?
Yeah.
But conventional can be a jumbo loan. It's any type of regular 30-year fixed. We call it A paper, full doc.
And jumbo means over 700 something?
Well, for Orange County, it would be over 765,000 in a lot of counties in America. I live in San Bernardino County. The limit is 510, which is the limit in all of America, 510, 400. So if I wanted to get a $600,000 loan in Yucca Valley where I live, I would have to get a jumbo loan. to do that. If I was in Orange County, I could get a conventional loan.
And what is jumbo? What's the difference between, I guess, a jumbo and a conventional? Does it mean like higher interest rate, or what is it?
Yeah, they're higher interest rates. The qualifications are much more strict. 43% debt ratio, I believe, is the maximum. 35% debt ratio for self-employed.
Got it.
12 months reserves, payment reserves in the bank after you pay your down payment. But they go up to $2 to $5 million. I've got a $2 million one right now that I'm working on. It's just a lot stricter underwriting, always 2 years tax returns. They never waive the appraisals, which is something we see happen a lot on Fannie and Freddie right now. Purchases and refis, no appraisal required. So that's the key difference. They're harder to get.
Why do you think that right now they're not? Why do you think that sometimes they allow for you to kind of waive the appraisal? Why is that?
I'm not exactly sure, why. I mean, I know COVID, they laxed up on it even more because people didn't want people in their house. But even before,
that's a reasonable
even before that hit, I mean, the market's pretty strong. The values were up, and the algorithms built into these automated underwriting systems we have is they're able to analyze public record data, and they're able to see there's a lot of $500,000 houses in this neighborhood. They put 400 in the system. Sounds like we don't need an appraisal.
How accurate are companies like Zillow now when it comes to valuing houses?
It's hit or miss. I usually, and I train my people to do the same, pull up a title profile from, a login we have with Stewart Title, and it pulls up all public records of all the sales in any area in America.
Got it. So you can look at like the sales of buildings next door to kind of see what the approximate value is. But how let's say like on a scale of like 10, 20% over under like Zillow, is it like that bad?
It's hard it's hard to say because I don't really look at it too much. I only look at it if I can't find other data.
Okay.
I've seen it super far off before, and I've seen it on point before. So I think it's kind of hit or miss.
Hit or miss. Now I understand what you're saying. That. Okay. And then the company that you're talking about where you can pull up title on previous searches and buys, is that something that's easily accessible, or is that like MLS for like people?
I mean, MLS is a great resource too. If you're a realtor, you can pull comps and close sales on there. Appraisers use it. Appraisers use the local MLSs. If you have a realtor friend or someone in your area, they're a great resource to check values of your home or any home you're trying to buy or refi. It's a proprietary login because we use Stewart Title for all of our title and escrow orders for our refinance business that we do. So it's a proprietary, professional login that we use with them. However, there is a way to do it on Zillow, and I do it if for some reason there's no data on Stewart. You can log into Zillow and you can go put, sold homes, and you can put in last 6 months. Very important to look in the last 6 or 12 months.
Got it, because obviously the market changes.
That's what appraisers do. They look in 6 months. If it's a rural area and they need more data, they'll go to 12, or they'll go out a mile and look at that map, and you're going to see all the closed sales. You want to click on the ones that are most similar to your house.
Got it.
Square footage wise, bedroom layout, remodel wise. You can even Google around on the internet and find pictures usually of the last time it sold. And that's what an appraiser does. They look for the most similar homes that have sold in the last 6 months or more recent, and they base their valuation on that. They take an average of the most similar homes, or their own, it's an opinion. It's an opinion what they think it would sell for, essentially.
Got it. Okay. So let's kind of sum it up for first-time home buyers. So when you're looking to buy your home, there's a couple things that you look at. One is going to be the debt-to-income ratio. One is going to be your income, right, as an individual. It's going to be your credit score. And then we're going to look at how much money you can put down. But the bottom line is, from what I'm hearing here, is that there's plenty of loan options for individuals, whether it's 0%, whether it's 3%, whether it's 5%. But you can easily get into a home if you really want to, and you should not be worried about paying 20% down to purchase a home. Of course, in California, that freaks people out because 20% on most average homes here are, running between $600 to $1 million.
Hundreds of thousands of dollars.
Yeah. $100,000 that you have to put down, and most people are never going to have $150,000 saved up in the bank because that's just not what they do. That's not how much income they make. So for that reason, they can come to you and they can explore different options. So from what I'm hearing here, it sounds like if you do put less than 20%, you have something called private mortgage insurance.
Correct.
So can you please explain what private mortgage insurance is, how much it typically is based on the loan, what are the factors that go into it, and when does it come into play?
So private mortgage insurance is used on conventional loans. jumbo and Fannie Mae and Freddie Mac loans. There's some jumbo products that waive the mortgage insurance requirement. They only go to 85% currently, but it's required to be purchased when you're putting less than 20% down on conventional loans. We talked about FHA and VA before. FHA's mortgage insurance is not private, it's government mortgage insurance, and it is fixed. It's 0.85% per year and 1.75% upfront, like we talked about. Conventional, it's private companies that are issuing these policies. It's just like an insurance policy you buy for anything else.
Okay.
It insures the lender against a certain percentage of losses.
Okay.
So for example, if you put 15% down or you're refinancing at 85% of the value of your house, the lenders all require across the board 12% mortgage insurance coverage.
Okay.
That means if you go into foreclosure and you don't make your payment, that mortgage insurance company pays out 12% of the loan to that lender to help them with the losses. What does that cost on a monthly basis? It's priced out just like an interest rate. It's based on your credit score,
okay, your
loan to value, your debt to income ratio, all those things.
So it's based on many different things. It's not like
it's a pricing engine, just like a rate.
Got it. And so do we, I guess, as the buyer or seller, do we have any, or buyer, I guess, would we have any influence on which company you use, or is there just a few companies that do this?
There's only a few. They all price pretty much the same. We kind of know which ones are better priced, and we try to lean towards them. You also have the option to buy out your entire mortgage insurance up front if you want to. That. Yeah, so right now on your refinance, I might be able to buy out your mortgage insurance for a 1% fee, just throwing a number out there. And you won't have a monthly premium.
What's the 1% of?
The loan amount.
Got it, 1% of loan amount.
So it may be a 1% fee, or they say we're just going to charge you 0.2% per year. It would take you 10 years to pay that. You're gonna pay down your loan to 78% naturally, and I told you, a year and a half.
Yeah.
Because you're on a 15-year fix. Yeah. So it wouldn't make sense for you. Monthly is the best. That's probably why I didn't even tell you about the other one.
Yeah.
So you do have options. When I bought my house in Tahoe, I bought it out. Reason being, I got a huge credit from the builder. So I made him buy out the mortgage insurance for us.
You got a credit from the builder? What does that mean?
Well, we got a big closing cost credit. Something else you should try to work in when you're buying your first house. Try to get them to pay closing costs for you. They can run $5,000 to $10,000 on any given house in any given place in America. Yeah. Generally, it's always at least 5, and it could be 10 if you're on $500,000 or more.
And so when you say buy it out, does that mean just getting a higher loan amount?
No. So we got it was just incentives. The builder was trying to get rid of these townhomes in Truckee, California, up in Lake Tahoe, and they were offering us $10,000-$15,000, and we needed to eat it up somehow. So we said, hey, let's do an upfront premium on our mortgage insurance. We put 10% down, second home, which is the minimum for a second home, by the way.
Yeah.
And
how much?
10% for a second home.
So if you're not a first-time home buyer, you have to put at least 10% down on your second home.
No, I mean a vacation home.
Vacation home.
Let's say you want to buy a house in Hawaii.
Okay.
That you're...
Well, I assume most people, their second home is not going to be their primary house of residence.
Yeah, so a primary residence, it can be your second, third, fourth primary residence. That's fine if you're moving up. It has to make sense. The underwriter's got to believe it. A second home is like a place you'd go vacation, not where you don't primarily live.
Got it. And let me ask you a question too. If you're buying another second home as a primary residence, that's not considered a first-time home buyer rate, so now you have to put more money down too?
No. The whole first-time home buyer thing is also a common misconception. The guidelines are the same for everyone: first-time, second-time, third-time home buyers. The only thing being a first-time home buyer might qualify you for, where you wouldn't get it if you had already owned a home, would be the 3% down conventional. You're still allowed to do it on FHA, but you got to be a first-time home buyer for the 3, not the 5. Okay. And then a lot of the down payment assistance programs are for only first-time home buyers. So those are the only 2 places it matters to be a first-time home buyer. Everyone's always calling me about the first-time home buyer special. It's all the same. We just look at your income, we look at your credit.
So as long as it's your primary residence, you can still kind of use those similar plans.
Yeah, the down payments I'm telling you about are all for primary residence. If it's a rental property, you've got to put 20% down, or 15 maybe these days. Second home, vacation home, you got to put 10% down for Fannie and Freddie guidelines.
Okay, so let's talk about the difference between those two again. So vacation home versus a rental property. So a rental property might be something that you're trying to do like Airbnb, or something that you're renting out to make an income off of. But a vacation home means it's a home that sits empty and you use it whenever you feel like it.
Correct. Yeah, whenever you feel like it, as long as it makes sense to the underwriter. You know what I mean? You can't. Let's say you have 10 rental properties in Barstow. and you say, I'm going to buy a second home in Barstow, that's not going to fly. They're going to say you're buying another rental property. You have 10 rental properties. What's in Barstow that you want to go vacation?
Yeah, that's what I was saying. How can you prove that it's going to be a vacation home, right? And
it just has to make sense.
It has to make sense for the underwriter?
Correct, yeah.
Okay, got it. And is the underwriter on your team or is the underwriter through the bank?
I mean, they're supposed to be on our team.
I meant do they work for AFN?
Yeah, they work for AFN. I'm actually looking to hire one right now. Guys, hit me up if you're an underwriter out there looking for a great place to work. Because right now I'm dealing with 20 different corporate underwriters and it's inconsistent. I can't stand some of them, honestly. I don't feel like they're on the same team, and they are supposed to be.
Yeah.
Their job is to protect the company. Their job is to make sure to get the second set of eyes and make sure you fit the guidelines that we proposed and in the scenario that we proposed, and that the company won't get stuck with a loan they can't sell because it doesn't meet Fannie Mae guidelines. They need to be there. It's a very important position. But these people can also turn into your enemy sometimes when you're trying to get a loan done.
So my question is if you're trying to just be like a shady individual, right? And you're like, this is my vacation home, but you plan on Airbnb-ing it. Is there a way to get around that? Or because what would somebody have to prove to you that this is just going to be our vacation home, meaning we're going to use it 2 times of the year? Like I
said, bottom line is if you only have one home, if it's in a resort area, or even if it's wherever, if it's just, it can't be right next to your house. Let me put it that way. Okay. You can't say I'm buying a second home in my neighborhood.
Yeah.
You can't say I'm buying a second home where I have 10 investment properties or a bunch of investment properties that is not a resort area. But they might even believe it. Like I have a, place in Tahoe or whatever that I rent out now. They may even believe it if you say, look, this is way better than all my rental properties and it's in Lake Tahoe.
Yeah.
You just write an explanation, your loan officer goes and fights the good fight for you to that underwriter, and you could potentially get it. Every scenario is unique, and we can fight for it. We can take it to management. I know the owners of my company, if I really believe in something, I can take it to the top and try to get it done. So,
and then you're saying the difference between vacation rentals and a rental income property, you have to put 20%, 15, or?
I'd have to look it up. It was 15, but it's really bad terms at 15. Nobody does it. The rates are super
so
bad.
It's typically 20.
20 is the smart. 25 is even smarter because there's less of a hit on the rate for an investment property at 25% down. So 20 is a good way to go.
Got it. Okay. And you don't do commercial loans. That's something completely different, correct?
I don't know anything about commercial loans. People ask me all the time. I'm surprised I don't know more, but this business is already so complicated. I haven't had room in my brain for it.
No worries. I have another friend, my buddy named Chase Cole. He does just commercial loans too. I'm going to have him on here as a guest at some point too.
But
he said it's a completely different
link
boost.
him up with me because I get people all the time asking me a good commercial person.
Yeah, he's having a boom right now too, so I'll definitely connect you to him. I know he was looking for to get more loan processors himself too. Okay, so to stay on topic here, so we talked about basically all the ways and all the things that people need to watch and look out for when they're coming to buy their first home. So at this point, what I do want to talk about is I want to talk about rental properties. You own several rental properties yourself. You own 6 or 7 of them yourself. Seven rental properties. So when you are going to purchase a rental property, let's say that you're somebody coming to you, they need a loan for a rental property. What is the stuff that they should be worried about? What is a little bit different, and what should they keep an eye out for, and what should they prepare for?
Rental properties are a little bit more strict guidelines in the sense that you can't utilize gift funds. That's something we didn't mention, but you can also use gift funds for a down payment.
Okay.
On a primary residence.
Gift funds means that somebody gifts you the money.
Yeah,
correct?
Friends, family. I mean, I think you have to say it's family, but as long as you say it's a family member, I think they're happy.
But it can't be from the bank or
it could be from an employer. It could be from a lot of different places. Yeah, it can't be from a realtor or your loan officer.
Got it.
But gift funds are an allowed source of down payment, but they are on second homes, but they are not on investment properties. So the other thing about investment properties, it's a little bit more like jumbo loans. You have to have reserves. So, and it's a complicated reserve guideline too. The basic is if you're buying your first rental property, you got to have enough for your 20% down and 6 months payment on that property in the bank after your 20% down. Okay. And payment is PITI. Principal, interest, taxes, insurance. If that's $2,000, you got to have $12,000 in the bank left over.
Principal, interest, taxes, insurance. Can you break that down one more time? What are each one of those terms?
Principal and interest is just your payment on the mortgage. Your $200,000 loan at 5% is $1,250 a month.
Okay, so principal is like actual payment towards the loan itself.
Exactly. That's your interest that you're paying the bank and the pay down of the balance every month, which is your base payment. Taxes and insurance are taxes and insurance. You have to have fire insurance. The lender does not want a burnt down home as collateral for their loan.
In California right now.
Yeah.
Nobody wants
and insurance is getting really expensive because of all the disasters we're having.
So taxes, let's talk about taxes. Exactly how do they calculate taxes based on the value of your home, and how much are you supposed to pay? Is it every quarter, at the end of every year?
Well, you can opt to have the lender pay it for you. In fact, we require it if you're less than 10% down in California or less than 20% down in any other state. At least that's my company's policy.
For how long do you guys pay it?
As long as you have the loan for. And it's collected in your payment, just like with your loan. So it's what we call impounds. You have impounds in your payment, or escrows.
Got it.
Or you can choose to pay it on your own if you're putting more than 10% down in California or 20% down in other states.
So you can opt in for you guys to do it for the duration of the loan.
It has to be if it's required to have impounds on that loan.
And then I know that sometimes you have to pay like assessments on top of those taxes, right? So what is an assessment?
Well, if there's a HOA you're talking about, or
let's say there's a tax assessment on the value of your property.
Well, the tax or the supplemental assessments maybe you're talking about. So sometimes when you buy a house, especially in California, they hit you for more taxes later because they only charge you the prior owner's tax rate. California is the only state that does this. They reassess on purchase, and it's usually anywhere from 1 to 1.5% of the value of the house. Some areas that are brand new construction areas, they could be as high as 2% in some places. I know in NorCal and some newer neighborhoods I've lived in, we've had very, very high taxes, almost 2% of the value of the house. But typically we use 1.25% as a round estimate for California.
And this is per year, the 2%, correct?
Per year, yeah. And it's paid in California every 6 months, and it's due no later than April 10th and December 10th. If you don't impound, you have to remember those dates to pay your taxes, your property taxes in any county in California. Other states, their dates are different. It varies by state. I have a big chart that we reference for that. Other states also, most of them, they do not change the taxes when someone buys a house. You inherit whatever tax rate it is. They change them whenever the hell they want. They decide, we're just going to make this the tax rate. And some states have very high taxes, some have very low. Nevada and Arizona, lowest property taxes in the country. Great places to own property, way less overhead, especially rental property. Rents are high in those states. Those are great states to invest in right now. Every state has different collection dates.
What were those two states again?
Nevada and Arizona. Arizona's about 0.5% of the property value, and Nevada's 0.5 to 0.75%. Hawaii also, but their property values are so high that they're much cheaper in Nevada and Arizona, and they've gone up a lot in prior years because of their low income tax rates and their low property tax rates. A lot of Californians and other people are fleeing to those states.
Yeah, no, and I know that they're planning on potentially raising the taxes again this coming year, depending on who gets elected.
Oh yeah, it's ugly. They were looking at a really high tax if you make a lot of money in California.
Yeah. Okay, so now that we've talked about investors, let's talk about the different types of loans and the timing on the loans. So we've talked about 15-year loans, talked about 10-year loans, talked about 30-year loans. Why would people go into these different types of loans?
Well, one is payment, what you can qualify for. Most people go for closer to the maximum they can qualify for on a 30-year loan, especially out here in California where we have pretty high housing prices. We're usually stretching to be able to afford that payment. For what our income is.
And it's because it's cheaper, obviously, the longer the loan.
Yeah, the longer the amortization of a loan, the more those payments are spread out over a longer period of time. Yeah. So you pay less principal because it's spread out over 30 years rather than, say, 15 years. Joe's dad, told him he should get a 15-year fixed loan. Yep. And that actually inspired me. And now I have all 15-year fixed loans on all of my properties. And the reason I do that, one, I can afford it because I don't buy super expensive properties. I like to be a little bit frugal in what I buy. And so my payments are still relatively lower than a lot of people's 30-year loans. Yeah. The rates are a little lower on a 15-year fix, especially if you have a lower credit score. I don't know why. I'm a credit expert. I can't get my score over 680. Can't figure it out. Everything's great. But because of that, a 15-year loan actually doesn't hit you for credit score on Fannie and Freddie, where a 30-year, they adjust you for credit score. So I'm able to get a way lower rate on a 15. And it also gives me like what I call a backup retirement plan. If the shit hits the fan and I stop doing well, I know at least if I can keep paying these mortgages, I'm going to be mortgage free by the time I'm 53 or whatever.
No, 100%. So. My dad was showing me, and that's why I ended up going into a 15-year loan, was he was showing the math. And when you do the math on like 30-year versus a 15-year loan, you're going to pay almost twice the value of the loan over a 30-year loan. And people think when you go into a 15-year loan, that means that your mortgage payment is going to be twice as much. It's not. It's not even close to twice as much. Maybe like 20, 30% more.
Yeah, 30%.
But like, you know, you're paying 30% more, but the money's not going nowhere. It's going into your equity.
Yeah.
So you're now gaining equity on your property faster. On top of that, you are going to pay, I think, like the math when we did it was instead of paying 200%, it was like 150, like you said. So you're saving hundreds of thousands of dollars sometimes in the long run. If it is $1 million property, you are saving hundreds of thousands of dollars. And not only that, but now you're going to have access to this money. If you need a loan, let's say a line of credit, something maybe to start a new business, you owe less. I know that our neighbors were saying that's what they did. They did a 15-year loan, then they paid off their place in like 12 years, and then they just took a line of credit to help their kids pay for their next home. So it's one of those things where a lot of people don't know what the benefits are because everyone just says get in a 30-year loan. Well, one, it's more beneficial for the banks. They want you to get in that 30-year loan so you pay more. And a lot of people just are ill-informed. So if you are looking to get a loan, definitely look into the options of a 15-year versus a 30-year.
If you can afford it.
Yeah, if you can afford it, of course. And it makes a lot more sense. It's almost like your own little savings bank, and it's going to help you out a lot.
Yeah, it's forced savings. And I mean, I tell all my friends, if I don't have the money, my wife can't spend it.
Yeah.
You know, so
that's funny.
You know, so
amen.
So the 15 years, and I don't notice it. I'd probably be paying several $1,000s less a month in mortgage payments if I had all 30s on my houses. But I don't really think about it because I'm just paying my bills, right?
Yeah.
But what that's doing is every single month, it's putting an extra several thousand a month in what I call my savings account.
Yeah.
It's a non-liquid form of savings account, but equity is a savings account, guys.
And not only that,
but
people forget they're not only gaining equity, but at the same time, your property is gaining value. So it's a smart investment, right? It's sometimes your equity and the property value raising is going to be more than what you can put into a stock. And a stock is so volatile. The one thing that you know about property is no matter what, at some point, your property value will go up because there will never be more land. Yeah. That is one thing on the planet that will never be more.
There'll always be more humans that need houses to live in.
There'll always be more humans. There'll always be less land. And look, right now, you know, even if, let's say, worst case scenario, recession happens again, right? And let's say that it does drop 40% value. In 20 years, it's still going to go up. And you're still going to have this equity, and you're still going to have this value, and you can gain access to it really whenever you want to. All right, so we've talked about the different types of loans. We've talked about what people can look for. What I want to talk about real quick before we segue into kind of a little bit more personal topics about yourself, and I, we want to talk about what are any major tips, like last tips that you would want to give people, right? I know right now, as you guys have heard, if you are not refinancing, if you own a property, you should at least call somebody like Ryan.
Just check.
You should really just call Ryan, and you should just check because it doesn't cost you anything. And for him, somebody like him, this is something they do every single day. It doesn't take, how much work does it take for someone just to check if it's a benefit for them?
Oh, it's a 5-10 minute conversation at tops.
Okay, so 5-10 minutes of your time to save hundreds, potentially thousands every single month. And not only that, but if you own multiple properties, you could potentially refinance all of them. I know that I just had a cousin that called Ryan, and he's refinancing 3 or 4 properties and his business loan.
4.
Because, because it just made sense. And, these interest rates are low right now, and these low interest rates are not going to be around forever. And hopefully they are around forever. I'm sure everybody would be stoked about that, but the chances are they're not. So you need to look into this.
They won't
check
be.
into it. Yeah, they won't be.
It wouldn't be good for the economy if they were around forever, unfortunately.
So, look into what you can do right now because this is the time to do it. Okay. And we've also heard that, these interest rates are going to be around for a little while, but it's not going to be a really long time. It's going to probably be until the economy gets back to normal. So let's keep an ear out for that and just really try to move on this time because it's going to be beneficial for you. So what is some last tips or anything that you'd recommend to people before they start reaching out to you to make the decisions, or just anything in general when somebody's looking to buy a home?
Well, I mean, honestly, step one is to talk to one of us. Talk to a professional who's good, who's experienced in the business, so you can start preparing. Because you may think you know what you need to do. You may think you need to save up X amount of dollars. You may think your credit's great. But until you talk to a professional who deals with it day in, day out and knows what these underwriters want to see, you're not really going to know because it's not what you do every single day unless you're a loan officer or a loan processor and then but you really need to reach out. Guys, you can reach me on my cell phone, 949-338-7564, 949-338-7564, or just drop a quick app in refi.afn.com. It'll go right to me or one of my LOs, and we can reach back out to you and tell you. So reach out, number one. Number two, don't get into debt. Do not buy that car. If you're young, buy a car cash. Drive a hoopty. It's okay. It will get you where you need to go. I hate the fake it till you make it saying. I really do. I really hate that saying. You need to make it instead of faking it. You need to make it so that you don't have to fake it.
Yeah.
So who cares what people think? I know it's hard here in Orange County. Everybody's so cool and they look so cool in their nice cars, but
tough.
A lot of them are just buried in debt and they rent an apartment, you guys. They don't own a house. I would rather live out in San Bernardino County and own a house and work at Walmart than be buried in debt here in Newport Beach.
Yeah.
So
let's also talk about one other thing. So for anybody that's looking to buy a house, look, I want you to call somebody like Ryan or your loan officer, whoever you may work with, because I know just like realtors and loan officers, they're a dime a dozen, meaning there's a million of them, right? But of course, work with a good one. But this is what you need to do. Look at what you're spending on your rent and look at what the cost of a mortgage is. For us, me and my girlfriend were getting ready to move to a place in Newport Beach. And the Newport Beach place was like $4,000 a month just for goddamn rent. And then we called Ryan. Right now, our mortgage is less than $3,000. So not only did we buy a place, but we now are putting money into instead of a pointless, shitty investment, which rent is a shitty investment. It's not an investment. It's actually just a straight loss.
It's just trash.
It's just straight loss. And you heard here today that all you have to save up is 3% down, or
maybe less if you qualify.
If you're a veteran, 0% down. So really look into your options because it's the smartest thing you can do. And we're looking to hopefully in the next year buy another place, and Ryan's going to help us out with that. And we're looking into options for that because we're going to just rent out our old place. And once again, it becomes like a retirement account. It becomes like your savings because then people start paying your mortgage for you. And then that money is now accessible to you in the long run. And you're going to gain equity, which is a benefit.
And by the time you rent that place, you'll be renting. Rent will be $3,000 a month. They'll be paying your mortgage, which is not just paying your mortgage. They're putting money in your savings account because about $1,000 a month of your mortgage, Joe, is just principal pay down.
Yeah.
So that tenant not only is covering your overhead on an investment that's going up in value, but they are putting actual money into a savings account that you can't touch because I know you'll spend it if you can.
I'll spend it so quick. Yeah. I'm a big spender.
And so it's not like guys like me and Joe, it's good that we're locked away from this money a little bit. Sometimes it makes me think about it if I have to sell a house to get some money to do something. It makes me not want to go buy something fancy sometimes.
No, I agree.
So yeah, guys, don't get into debt. Don't finance that BMW. Okay, don't do it. Don't do it.
I'm
just
that asshole.
Buy the 1999 one that's in good condition or whatever. Just deal with it until you get into your house, until you get more established. The biggest mistake I see young people make is getting buried in debt so that they can look cool to their friends, or get a hot girlfriend or whatever. If she only likes you because of that, it's not going to work out, guys.
That's
it's not going to work out.
I want to change gears now. So let's talk about one of my favorite questions because I've learned a lot of weird shit about people and the people they deal with. Who are your worst clients ever? Well, don't tell me who specifically, but tell me.
Do that,
yeah, of course, don't tell me that. But I don't even think I want to know. I probably know some of your worst clients ever. Let's be honest here. But let's talk about what did the worst clients ever do to you, and what did they teach you? Because if there's one thing I've learned in my industry is the only time my processes get better is when somebody fucks something up in my business so much that I literally have to make a change to do something a different way.
I mean, I think the worst clients are the same type of personalities for all of us in all industries. Some of the worst people out there, I can't think of too many specific stories because I block them out sometimes, but some of the worst ones in the past, they're people that they think their house is so great and they tell you all these wonderful things and how much it's worth and all that, and you get an appraisal and it's a complete dump and it's falling apart. And then they want to cancel on you like it's your fault when this thing doesn't hit. And then they want to write you a letter and say they're going to sue you, And sometimes you just have to pay it just because you don't want to deal with them. Just because you don't want to get another phone call from this annoying person. Yeah. Don't do that to me, guys, just because I told you that. But but anyway, no, those are some of the worst. But there's one recent client that really comes to mind. And this client actually was a loan officer, for a successful loan officer for a bank. Another company, not ours.
Well, why would he call you to do it? Why didn't he do it himself?
That's a great question because I don't know, their turn times and their pricing was awful, and they heard from another coworker whose loan we did. That we did a good job and this and that. And this individual was a loan officer, so you would think, awesome, a loan officer. They know exactly what I'm going through, right? They're going to totally get it. Yeah. I mean, I'm the easiest client. When I do a loan, when someone does a loan for me, I'm like, boom, boom, boom. Here's all the stuff I know you're going to need. They love it. opposite with this person, okay? This particular person wanted to argue about every single thing that we did. We would ask them for something as simple as, hey, what's the contact to your HR so we can get your employment verified and your commissions and all that? And they would say, don't you have an assistant to do that for you? Or something along those lines. It's much easier if you just tell me because you work there. You know what I mean? Rather than have my assistant take an hour of their time blowing up the circuit board.
I want to comment on this because this is something I've been dealing with lately. So it is literally astounding how individuals are so goddamn lazy when it comes to just doing the simplest things right now. Like when I ask a client to print a piece of paper, put their signature on it and scan it and send it back to me because the insurance company requires a wet signature sometimes. I will literally have to argue with the client for 15 minutes over something that they could have done in those 15 minutes. And it's crazy that technology has made people so lazy. Like now I can't even send people, so I won't send people anything that isn't electronic signature anymore. We've created jot forms. I don't know if everybody doesn't know what jot form is. And your company sends people the same PDFs over and over again, asking them to answer questions. Look at jotform.com and go sign up for this company. What you do is you fill out your own fillable PDFs. You send them one question at a time, and then people can do it on their phone because people are that lazy that they don't even want to go to their computer. To print
they want
to
sit on their couch with their phone.
It's insane. So, it's like you almost have to accommodate the laziness that's developed. And luckily with the older generation, it's not that bad. But the younger ones, oh man, if it's not easy peasy, they can't get it done in 10 seconds, they won't even do it. It's absurd. And they've almost got this whole entire mentality where it's like, you're not accommodating to me. I'm not going to work with you. I'm going to go work with somebody else. It's like, come on, just work with me a little bit. And it's the simplest of things. So I understand the struggle that you're going through.
Yeah. And this bad client story. So this person, so that was just the start of it. And we were like, oh, wow. Okay. All right. So you don't want to be very helpful. Okay. But we, of course, we're professionals and we proceeded and kept our cool and, didn't tell her she needed to do that. And we figured it out and paid our people extra time to go do that. Throughout the entire process, there's conditions that are needed on a loan. You get underwritten. The underwriter asks for 20 things, especially a commissioned person who owns a lot of properties. There was a lot of conditions needed. This person argued about each and everything, worse than clients who know nothing about the loan business. So it was just shocking to me that this was a professional and a successful one at that. That they wanted to argue about everything. And not only did they argue, they were condescending constantly to me, to my staff. They made me second guess my own abilities from time to time.
Dude, it's tough. And I don't understand why people do that. They came to you to get help. And I think some people forget, we're on their team, right? I sometimes get into arguments with my clients and they're like yelling at me. I'm like, you realize that I'm trying to do what's best for you. I understand it's not the ideal situation for you, but you kind of I think people assume nowadays, I'm hiring you for this service. I don't want to do shit. I want you to handle it all. And some people forget that it's actually, I need information from you. I can't do my job until you give me what I need to do my job. And so this is something that in my initial intakes, I've trained everyone on my team to tell people, look, just because we're your attorney or we're representing you for this case, so on and so forth, it does not mean that you're not going to do anything. You need to respond when we ask you of things. You need to do this. And we make it very clear with our clients because we've had some really bad scenarios. We're like, we will drop you as a client. We will not represent you and you'll be on your own if you do not respond within this time limit. And we set very clear guidelines because you can't do your job unless people are giving you the tools to get your job done.
Yeah, and that's eventually where we ended up with this person. But I clients ask me all the time, how long does it take to close a loan? I say, that's up to you. Say, here's our turn times. Here's the fastest.
That's a good answer.
I say, here's the fastest we can do it. It really is. Here's the fastest we can do it. But that really depends on you turning around and getting me everything that I asked for right away. It's a team effort. It's a big deal. We don't just give out $500,000, $500,000 just because you asked for it. We don't. And people still fail to realize that. They love entitled. To get, they're so entitled. But anyway, so this client continually, made my processor cry. Was just so mean and rude down to the last minute, and even asked us to do another loan, a refinance. We closed the purchase loan, asked us to do another loan. And we started on that. And then there was an issue with the appraisal taking, they were backed up a month. It was a unique property that it was in that area. The appraiser was backed up for a month. And I said to this client, we're going to have to let your rate lock expire. because there's no way we're going to close in time, and we're just going to have to relock you current market. And this person said, well, no, that's not acceptable because you didn't know that appraisal was you didn't tell me that in the first place. You're going to have to pay for all of my lock extensions indefinitely, which could end up me losing money to work. Yeah. And I said, no, I'm sorry. Like, it's not a good fit if you want that, because we aren't going to do that. I'm not going to commit to something that could put me completely in the red so that I could pay to have to deal with you. Yeah. You know what I mean? I'm not going to commit to that. Yeah. I think that you'll be fine. I think the market's going on downward trend and you should be good, but yes. And you do have to pay for your appraisal. I'm not going to pay for that for you. That's part of the process. Yeah. You know this, and this person called me and actually just continually put me down. Basically telling me that I should do my job more like how they do their job. And, I probably do way more loans than they do. Yeah. But, was putting me down, and I had to keep my cool. And that's one of the lessons I've learned in my life over time, is that you can't escalate with people like this, because they will keep on going up that elevator with you. Oh man, dude. And it will end up real bad. And I mean, and this lady, I mean, she was a true Karen, asked to speak to my manager, my manager's, he knows who you are. Yeah, exactly. It's fine. And so I gave her, I was like, wow, that's the first time anybody's ever asked to speak to my manager. Dude, you have Karen.
You have to be like super careful, right? I always talk about you have to be intentional with your time and your energy, right? Your energy is a part of dealing with difficult clients, and you have to sometimes recognize that you're at an impasse, right? And sometimes it might just be that your personalities don't mesh, right? And it's like, maybe just refer it to a friend, and that's also scary, but sometimes a friend is better at dealing with that type of person. I just know that for me, I try to, and the reason I know this is because I dealt with a crazy client that ended up reporting me to the state bar and dealing with all kinds of shit because they were bipolar personality disorder, diagnosed with it. And I knew going into this case it was a really bad idea. Well, now that I've dealt with it, I just now listen to my gut. If something in my gut tells me this person is going to be your worst nightmare, I haven't been wrong since. Yeah. And I will do everything I can to just be like, here's this. And like most attorneys, when I drop a case, I can put a lien on the case, which means that I'm entitled to fees for my time. I waive it, I drop them, I say, God bless, have a nice day, you're on your own, go figure it out, go make somebody else's life miserable. And sometimes it's not worth a couple $1,000s. And for you, it's like same thing. Just got to know when it's time to let them go.
Yeah, that's actually what I was going to say, because you asked what lesson we learned from that. I literally fired this person as a client. Yeah. It was a big loan. It was like a $600,000 loan. Yeah. We made good money on that, but I had to fire this person as a client.
It's not worth the dollars.
Yeah, because again, I don't want her crying. She knows the regulators that we deal with. She's a loan officer. You know what I mean? So I don't need this person going and crying to regulators. Then I have to respond. Then I got to get my attorneys involved and all this extra time, and my time is money, and these attorneys will probably charge me. I probably have to have you write a letter back. You know what I mean?
I would have been writing the letter.
So,
but I mean, those are fun conversations.
So I had to tell this individual, this particular client, I had to remain calm during this conversation when I wanted to snap back so bad and tell her how much better I am than her in this industry, and and blah blah blah, but. I kept my cool because I knew it wasn't going to go anywhere, but more fighting with this person. And I said, I'm sorry. I just don't think it's a good fit. I can't accommodate what you're asking for. And, and I said point blank, I said, why, what is the problem? And I said, well, you're just difficult and you're condescending and it's affecting my staff. You know what I mean? And well, I think that you're condescending and and it just was, there was never a right answer.
Never a mesh.
There was never a right answer. And I said, okay, I'm sorry. We're just going to have to agree to disagree. And asked for my manager's phone number. Sure. I gave my manager a heads up, and that was that. I don't know if she ever even called him, but the lesson learned from that is exactly what you just said. Same thing. Trust your gut. I knew from the first conversation that this lady was going to be difficult. I knew it was going to be a problem for us. And I especially knew it moving along, in things. Don't be afraid to fire a client, you guys. You don't need the money that bad. No, you don't need the money that bad.
It's not about the clients that you keep. It's about the clients you don't take a lot of times that will define your firm. Because if you're spending 20% of your time on something that's worth 1% of your money instead of spending it on something that's worth, it's like the 80-20 rule, right? Like usually it's a lot of your bigger ones are going to be the bigger value. You need to make sure you're spending your time and energy where it's most spent. And a lot of times people will keep these clients because they're worried about a review on Yelp. They're worried about this and that. But you know what? The bottom line is if somebody's vindictive and they're going to do it anyways. And the longer you hold on to them, you're just prolonging the inevitable. So you need to cut the cord. I say cut out the cancer. That's like one of my favorite sayings. You got to cut out the cancer in your life so you can begin to heal and start moving forward.
And that applies to more than just clients.
Yeah.
That's, we'll get into that in a minute too.
Yeah.
I mean, it's just, you got to know when to cut people out of your life.
Family.
Yeah. I mean, it will take years off of your life.
Yeah.
It will cause you stress. It's not worth it. Life's too short.
Yeah.
Not worth it. On to the next. Go call some new leads. You know what I mean? And drop those people politely and professionally, but drop them, because they're going to make your life hell when you see things going south like that. Don't worry about that commission.
Yeah.
You'll get 3 more with less work.
I agree. All right. So we're going to segue into the next question I'd like to ask, which is, what is a mistake, or what is one of the biggest mistakes that you made potentially in your life, in your career, that's helped set you on the path that you're on today? I know sometimes mistakes are emotionally a lot to think about and they're tough, but I really think that it's mistakes that really help define who we become in the end, and the end of path that we end up on. So can you describe what happened to you, or what might have pushed you this way?
Well, I can't get too specific, but it does tie kind of into even what we're talking about with this bad client situation, and engaging in conflict. So the biggest mistakes I've ever made, and it's a series of mistakes in my younger years, almost always had to do with remaining engaged in conflict with people, whether it was my ex-wife, whether it was friends or family or whatever. You cannot remain engaged in conflict with people. And I think a big turning point, which made me realize this, I forget who gave me the example. I think it was a therapist or something. They said, when you're fighting with someone, like if me and Joe are just going at it and we're so pissed at each other, it's like we're in like an elevator shaft that goes up infinitely and there's mirrors behind us. And every time someone escalates or yells or, lashes back at the other person, they raise up in that elevator shaft, and you guys are looking right at each other, raising up. The second you stop raising up with that escalation, that other person can only see themselves in that mirror behind you. And that particular analogy, it was like life-changing for me with my ex-wife situation going on at the time. We're going at it, and I just realized that I just have to stop engaging in that conflict, in this particular situation. And it wasn't just her, it was happening with all kinds of people in my life. Yeah. And that was a big turning point for me, and helps me deal with situations like the one we just talked about, better today. So without getting all the, hours and hours of details of these situations, it boils down to not being engaged in conflict, and also not keeping people in your life that tear you down.
Yeah.
Not keeping people you should only have uplifting people in your life. You should only have a spouse or a girlfriend or a boyfriend or whatever in your life if they uplift you. My wife tells me how great I am every day. It's not fake. She really thinks I'm great. She
likes to lie as often as possible.
No, it makes me feel good, and it makes me confident, and it makes me good at my job, and it makes me good as a dad and a husband, and you know what I mean? And the same with your friends. I mean, I really have to say that all the friends that I'm close to in my life, we all uplift each other. Yeah. We all like each other.
Except for Ryan Murphy.
Yeah, except for Ryan Murphy, yeah. I hope he hears this.
Elevator shaft, specifically. That's an amazing analogy. I've never heard that before, and it's so true. It's like, as long as somebody's in front of your face and they're in front of your face and you're consistently engaging, this is something I've been learning in my life, right? I'm getting a little bit older, a little bit wiser, and I've just noticed that when somebody's acting crazy or when they're doing crazy things, if you do crazy things back to them, nothing ever gets changed. Nothing ever, you just literally keep going crazy. And this is something
until someone gets tired.
Somebody gets exhausted. This is something my girlfriend showed me, because she's the most chill, relaxed person. She doesn't yell. She doesn't scream. I came from a family. We yell. We cuss at each other. And it's like, she just showed me, she's like, all you guys did was yell and cuss at each other. Nothing was actually resolved and nothing was solved. And, this is how I was raised. And so now I'm trying to take a step back and realize, we need to approach things differently, or else you're going to, craziness is doing the same thing over and over again, expecting different results. And so you need to change the way you're doing things, or else it's never going to make a change. So that's amazing. That's a really good analogy. Thank you for sharing that.
Yeah.
Okay.
Yeah, it was life-changing, just that one weird little analogy. And I think about it all the time. Whenever a conflict starts, I just, okay.
Yeah.
And they have to come back down real quick.
Yeah, they either are going to go, they're going to keep going.
They're going to be fighting
themselves.
They fight with themselves. It's really, it's funny to watch, and it looks ridiculous.
Absolutely.
Blah, 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 yelling at you, and you're just, Okay.
Yeah.
Right.
I just finished a book called Never Splitting the Difference by Chris Voss. It's a negotiation book. And he talks about like, you should never ever negotiate or argue with people in an aggressive manner. It doesn't get anywhere. The real way to, get something accomplished and to get what you want is you need people to understand where you're coming from by doing it in their own way, right? So it's almost like reverse psychology where you're asking people questions and you're letting them think about your solution. If you're yelling the answer to their face and you're shoving it down their throat, they're not going to be responsive to you. They're not going to trust you. They're not going to respond. So it's important to like make sure you're doing those things that way. So let's talk about now. So you are top 10 out of 900 people for an industry right now that's booming. That's really impressive. What are the habits, or what do you think some of the habits that make you a successful business individual, right? You work virtually, you have plenty of properties, you obviously are established, you know what the hell you're doing. What do you think are some of the habits that make it so that you're able to have a good work-life balance and really crush it, even though you're not in an office every day managing a bunch of people, but you're still top 10 in this company out of 1,000 people?
There's a bunch of things that come to mind, and I'm sure it's shared amongst successful people, but I like the number one thing I'd say, if there was a word for it, I don't know if there is, but anti-procrastination. I mean,
you get shit done.
You got to get the ball out of your court instantly.
Yeah.
And this is the problem I have with underwriters in my industry, is they just sit on things and they take forever. There's ways they can manage their time where they could do quick things first. Yeah. You have to really analyze all your tasks. Just because someone came in line before another one doesn't necessarily mean you shouldn't do one thing first, because some of those things take you 2 minutes. Some of those things take you 2 hours.
Yeah.
So, that's two different things I'm talking about, but I never procrastinate in anything in life, personal, business, whatever. I just get it done as
That's
much
amazing.
as I can. I have my lazy days and my off days just like everybody else.
Yeah.
But 9 days out of 10, I am not procrastinating. Even if I have 2 weeks to do something, I just do it. My continuing education for all these licenses that I have, and, in all of America, I did it. It's just done. I did it as soon as I could, because you don't want to be scrambling to do that stuff at midnight on the deadline. You don't want to be scrambling to do that paper in college or whatever it is.
No.
You cannot procrastinate. That's the number one habit. Let's see. The other things is...
Well, I want to talk about that for a second.
Okay.
I mean, I think that's just amazing, because I know that's been one of my biggest weaknesses. I'm always procrastinating. And what I'm realizing is, when it comes to procrastination, right, when we talk about like your time and mental capacity as an individual, if you have something you need to get done, not only is procrastinating the wrong fucking thing to do, but now you are just taking this much space in your brain that's stuck. Until you get that done, it is now occupying, and it's there, and it's there, and it's there, and it's there, and it's there. And until you do it, it is not done. So if you're just getting shit done, you're probably significantly more stress-free than the average individual, is what I guess.
Yeah, it's stressful. And I used to be a lot more stressed. This is a stressful job. People are on your case, and it's emotional, and they're big deals and transactions, and people are upset a lot of the time. And, I don't really get stressed out anymore, and I'm busier than I've ever been. I refuse. That's the other habit. You got to refuse to be stressed. You got to make it a choice to not be stressed, and keep telling yourself it's okay.
Yeah, you're choosing.
It's okay. Yeah.
Most people have to say, I have to do this. It's not I have to, it's I get to. I'm blessed to do this, right? People are 800, 700 people are calling you, and they're like, I need your help. You can either be stressed out about it or be like, fuck, I'm doing a great job. People need my assistance, and I'm just going to take it one step at a time. But you have a different approach. You just get shit done as it comes your way instead of like waiting. And that's probably why you're so successful.
And I get backed up sometimes, and I keep a hand. I like technology. I use everything paperless and all that, but I keep a notepad on my desk. I have it with me. And I hand write out those things, because I will forget. I have a great memory. I have a really, really good memory. Yeah. But there's so much data going through my brain with as busy as work is right now that I will absolutely forget. So I write down those things as I start to get backed up, and I work through it step by step, and I'll cherry pick out the stuff that I can get done quick. Yeah. It makes me feel better. That list gets crossed off faster, and I kind of save the hard things till the end, unless it's an absolute emergency, which you got to know when to prioritize. You got to know when, you're going to lose this deal if you don't work on this one, or this is a 2-minute quick thing, and then it can keep moving forward.
I got you.
So anyway, that anti-procrastination, being grateful every day when you lay in your bed and you're in that comfortable mattress, and you've got a significant other, you've got children, you've got a beautiful home, or whatever it is that you love in your life. be grateful to God, to the universe, to whoever. Be grateful every day. Be grateful. That will take away a lot of stress. It could always be worse. Could always be worse, guys.
Definitely.
There's always a worse situation. Know when to delegate and know the limits of delegating with people. That's probably the final thing that I'll say. I got to know the limits of the people that work for me. I can't put too much on them. I can't tell you how many people I see, especially branch managers like me. They get a new processor or someone and they just boom, take all my apps, take all my calls. They want them to do sales for them. They want them to do, there's a reason they're not a salesperson. You know what I mean? There's a reason they are not making big commissions selling loans, because they maybe aren't that comfortable talking to people. They want to sit here and do paperwork in the back, behind the scenes, you know?
And it's important to remember that. I
know the limits of delegating, test their limits, push them for greatness, you know, give them more and more and more until you see that they're struggling, and then pull it back. I do a lot of my people's jobs for them, and I don't even dock them or anything for that. They still get their bonuses when we're busy. And don't be afraid to do that. Don't be afraid to jump in. Make it a team thing, no matter what business you're in. Jump in and help. I tell my whole team, everybody's here to help each other. If I hear anybody who's not willing to help another person when they're not busy and that person is,
you're gonna let them go.
You're not part of this team.
No.
Everybody needs to cover for each other. I got people covering for me right now while I'm talking on this podcast. My processors I see 2 days go by and they did get conditions out to Joe because his approval came in. I'm doing it for him. I processed your loan myself. I didn't even give it to a processor because they were so busy. And you're my friend and I wanted to go fast.
Well, thanks.
You know, so, you know, and I don't have to do that. That's kind of below my pay grade, but I do it because I don't want my people to get overloaded. I turned off the marketing because I didn't want to give bad service and have too many loans, even though I could have made more money potentially.
But you're doing a great job. So let's talk about now the last thing. How can people get in touch with you? How can people reach out? And how can people, if they need to refi, if they need help now, what should they do to get in touch with you? I know you said your phone number. Let's hear your email. Let's see your website.
Okay, cool. So I'm just going to make it real simple. Like I said a couple times, refinancing.com. It actually takes you direct to a really easy, simple to fill out loan app. We'll call you first. We're not just going to pull your credit. You don't have to put in all the information if you want. If you're just curious if you qualify for a purchase or a refi, pop your info in there. Me or one of my talented loan officers will give you a call back instantly, probably within an hour of you doing that, as long as it's not 2 a.m. when you put it in. My cell phone number 949-338-7564 goes direct to me. If I'm too busy, I'll hook you up with one of my people. They're all great. That's why I hired them. I don't know my 800 number offhand. I should have memorized it for this,
cell phone's better.
Call my cell phone.
You directly.
You're gonna get me. You're gonna get me. 949-338-7564. Our corporate website, afncorp.com. That's for the whole entire organization as a whole. There's like 300 branches just like me there. So, the refi with afn.com will take you direct to the app, which will go right into my branch. It'll migrate right into our loan system. And if you want to move forward, it makes it very easy for us to start that process if you do that.
Perfect. All right, Ryan, thank you so much for being here today. I appreciate it. This was super informative. If anybody has any questions about loans, mortgages, or whatever it may be, please reach out to Ryan. He's going to be always a great resource. He's one of my favorite people on the planet. Thank you so much for coming and spending time with us. I hope everybody has a great day and look forward to seeing you soon.
Bye, guys.
Cool.